The call we're making is that the market internals, in terms of percentage of stocks above their 50-day and 200-day, have reached a level that have normally signaled real panic and have marked the bottom. So we believe the sell-off is behind us.
Do you think that this, in terms of technical damage and percentage moves, is commensurate from where we've seen bottoms in the past, or do we not need as much because the numbers are bigger, but the percentages aren't?
Well, it's one way to measure that is how often have percentage stocks above their 50-day fallen to 11%, which is what happened on Friday, and the percent below their 200 days.
So it's the breadth. I'm sorry to interrupt. It's the breadth of this decline, not the depth of the decline. Yeah. And it's been a long one that we didn't maybe notice right at the beginning. It's stealth.
Yeah, it means 90% of stocks have completely broken down below their 50-day, which means they've really broken intermediate trend. It's only happened, when you look at the Russell and the S&P, it's happened 9 times since 1990, of which 3 of them we were more than 1 year into a bear market, which has not happened. We're not 1 year into a bear market. So we can look at the other 6 instances. Those were almost to the day the bottom of a correction. So that would have been like March 2009, late January 2016, and the recovery tends to be quite violent because what you have is a panic that has brought the market to that level, and it looks like we're going to rally like more than 13% over the next 3 months, which would
just because people feel like they are missing out on an opportunity to buy.
Yeah, what happened is everyone looks around, sees selling, and they think something else is wrong, and a lot of value at risk models, which is how hedge funds manage risk, say we got to get out at any price. That type of imbalance of selling has sort of crushed the internals of the market.
I mean, that has certainly been the case where you needed to buy the dip, but we've been talking about whether that strategy has changed at some point because we are later in the cycle. And I guess that's the question.
Yeah, the late cycle is the unknown at the moment, but a couple of things to keep in mind. Unlike the January sell-off, first of all, this is worse internally than the January sell-off, so this reading has brought us to levels we haven't seen since 2015. But in January, the yield curve was flattening, so we could have worried about being late cycle. This time, the yield curve steepened. Interest rates, have actually backed up a little bit, and investment grade and high yield have outperformed the equity drawdown. High yield and equities usually have the similar, what they call Z-score move, and it hasn't happened. So I think it's just a correction.
All right, David, I hope you brought it today. David Joy, because Tom just gave us this big exclusive call that, if you're just going to come on and just give us the average stuff, we'll just stay with Tom. Do you have something big for us, David?
Well, I'm basically of the same mind as Tom. I do think that maybe we've put in at least a near-term bottom. I think this sell-off was primarily a repricing in response to Chairman Powell's remarks about being too far away from neutral back on October 3rd, and from that point, you had a repricing downward almost across the board. And so I think that process has more or less run its course. However, I'm not willing to say that that means that the upside is open-ended. I think we're going to be in a trading range now that's bounded by the lows that we've witnessed over the last couple of weeks, but also now bound on the upside by the previous high, roughly 2,900. In order to break through there, I think we're going to need to see some progress on either the China situation or some softer economic data that gives the Fed a little reason maybe to pause and gives Wall Street some optimism that they'll pause. So we're basically of the same mind, I would say, that maybe a near-term bottom has put in.